33,000 jobs gone, 735 stores boarded up. For decades, Toys R Us was the absolute undisputed king of retail. I mean, it was a total category killer that shaped millions of childhoods. And then, seemingly in the blink of an eye, the entire empire just collapsed into a massive financial crater. September 2017. That's the exact moment the floor fell out. The company abruptly filed for bankruptcy, and it sent immediate shockwaves through the entire industry. You had suppliers who were suddenly terrified they wouldn't get paid. They completely panicked, demanding cash on delivery for their goods right then and there. And this caused massive supply chain friction right as they were heading into the absolutely crucial holiday season. Keep in mind, that season traditionally accounted for 40% of their annual revenue. So the resulting holiday quarter, an absolute disaster. It sealed their fate. But to really understand how it came to this, we actually need to look back at the empire they built. The whole thing started back in 1948. Charles Lazarus had just returned from World War II and opened a baby furniture store in Washington, D.C. But he quickly noticed this huge trend. Parents just kept asking for toys. So he added a small toy section, and before long, it outgrew literally everything else in the store. By 1957, Lazarus had a massive revelation. He realized nobody was specializing in toys at a truly massive scale. So he opened the very first toy supermarket. We're talking enormous, floor-to-ceiling shelves, warehouse-style aisles, thousands of products, all at the lowest possible prices. He named it Toys R Us, and this model was devastatingly effective. If they refused to stock your product, well, your toy was basically dead on arrival. By the late 90s, they had exploded to over 1,500 stores operating across 38 countries. They commanded 25% of the entire US toy market and were driving over $11 billion in revenue. Geoffrey the Giraffe was, for sure, as famous as any cartoon character on TV. And this brilliantly illustrates the strategic trap that was just waiting for them. See, Toys R Us relied on one primary revenue stream: toys. They absolutely had to make a profit on them just to survive. But meanwhile, Walmart was growing relentlessly, followed closely by Target. These massive big box retailers started using toys purely as loss leaders, meaning they'd sell toys at zero margin just to lure families through the physical doors so they could sell them groceries, clothes, and electronics. Suddenly, Toys R Us wasn't the cheapest option anymore. And sitting right next to those shiny new supercenters, their legacy warehouse stores were starting to look incredibly tired and really expensive. Then came the internet. And in the year 2000, Toys R Us made a catastrophic $50 million error. That's the exact amount they agreed to pay every single year for an exclusive agreement to be the sole toy seller on this fast-growing website called Amazon.com. Think about that. Instead of building their own robust digital storefront, they decided to just outsource it entirely. They quite literally handed their online customers directly over to their future killer. Well, Amazon was eager to expand its own empire, right? So they eventually totally betrayed that exclusivity agreement and just allowed other toy sellers onto their platform anyway. Toys R Us, understandably, sued. But here is the tragic irony of the whole thing. They won the lawsuit, but they ultimately lost the war. Because by the time they severed ties and finally built their own e-commerce site in 2004, the battle for the digital frontier was basically already over. Being 4 years late by internet standards, it meant they had completely forfeited the space. So the crucial point is, e-commerce and big box competitors weren't actually the fatal blow. The true killer was $6.6 billion. In 2005, the company was taken private in a highly leveraged buyout by KKR, Bain Capital, and Vornado Realty Trust. And this right here is exactly where the story of a struggling retail giant pivots from a slow decline into sheer tragedy. You see, this buyout didn't inject the company with fresh capital to go fight Walmart or Amazon. Not at all. Instead, it loaded the company with $5.3 billion in crushing debt. The private equity firms borrowed the money to buy Toys R Us, and then, get this, they put the responsibility of paying back that massive loan directly onto the balance sheet of Toys R Us itself. This staggering financial burden aggressively starved the company of the vital money it desperately needed. They couldn't renovate their aging physical stores, they couldn't upgrade their e-commerce operations, and they couldn't invest in a better customer experience. For 12 long years, the company staggered under impossible math. It's actually wild to think about. In a good year, Toys R Us generated around $500 to $600 million in operating profit. That sounds amazing, right? But the annual interest payments just to service that leveraged buyout debt were $400 million. Almost everything they made went straight to Wall Street just to tread water. There was virtually nothing left over for growth. The debt literally ate the company alive from the inside. The grim finale arrived in March of 2018. All 735 remaining United States stores were liquidated, just gone. In an instant, 33,000 people lost their jobs. And the emotional weight of this collapse hit the public incredibly hard. I mean, it was perfectly captured by Jeffrey the giraffe's final viral social media post. Just the iconic mascot walking away from an empty store with a single suitcase in hand. People actually cried. Yet, here's the craziest part. The global toy market at the time was still absolutely massive, worth $90 billion. Toys R Us didn't die because children suddenly stopped wanting toys. The demand was absolutely there. Families simply lacked a dedicated place to discover them anymore. You know, a place to just wander the aisles and be genuinely surprised. A company that survived every competitor for 5 decades, ultimately killed by its own debt because private equity simply extracted its future.